All right, let's dive right in. Today, we're putting on our forensic accounting hats and taking a highly objective, deep dive look into the red herring prospectus, or RHP, of a Leapfrog Engineering Services Limited. You know, when a company prepares for an IPO, that RHP is literally the ultimate source of truth. It's the financial DNA of the entire business. Our goal with this explainer isn't just to glance at those shiny top-line revenue numbers they really want us to see. Oh no, we're going to peel back the layers, structure the data, and get a crystal clear picture of the structural realities, the potential red flags, and the actual cash flow mechanics going on behind the scenes. But before we get too deep, I need to make one thing absolutely clear. This video is purely for educational purposes and does not constitute financial advice. Please consult a SEBI-registered advisor before investing. We're just here to impartially report on the hard data and empower you to do your own due diligence. Okay, so here's our audit plan for today. First, the business and clients. Then, following the IPO money, followed by a forensic financial deep dive. After that, we'll hit key risks and red flags, then peer comparison and valuations, and finally, the final takeaway. Let's get to work. Section 1. The business and clients. So, Leapfrog has actually been around since 2005. They operate as an integrated EPCC contractor, which stands for Engineering, Procurement, Construction, and Commissioning. Basically, think of them as the architects and builders for super complex industrial systems. We're talking electrical networks, instrumentation, industrial automation, and fire safety systems. So if a massive oil refinery, a pharma plant, or even a giant food processing facility needs a highly complex, customized electrical substation designed, procured, built, and fully turned on, well, Leapfrog is exactly the kind of company bidding on that contract.
But here's where things get super interesting. Notice this extreme concentration. Even though they operate across all these different industries, their actual customer base is incredibly narrow. According to their own RHP, for the financial year ending March 31st, 2024, a staggering 98.81% of their revenue from operations came from just their top 10 customers. And in the year before that, it was over 99%. What this tells us is that Leapfrog's whole business model heavily relies on securing massive, high-value contracts from a very, very small pool of major clients, rather than having a steady stream of smaller projects from hundreds of different buyers.
Moving right along to Section 2, following the IPO money. Now, as you probably know, an IPO involves selling shares to the public. But where does that cash actually go? Well, it depends on the type of shares being sold. Here, we clearly separate the two. Leapfrog is offering a fresh issue of up to roughly 3.46 crore equity shares. The capital raised from these fresh shares goes directly into the company's bank accounts to fund business growth. Simple enough, right? But there's also an offer for sale, or OFS, of up to roughly 38.7 lakh equity shares. The funds from the OFS absolutely do not go to the company. They go straight into the pockets of the selling promoter, Mr. Prabhav Narasimha Rao, who is basically cashing out a portion of his existing ownership. And you've got to see this specific number tucked away in the disclosures, literally 1 paisa per share. That is the weighted average cost of acquisition for the promoter shares being sold in the OFS. So to put that into perspective, while the public is going to bid on the final issue price at a significant premium, the promoter initially acquired these exact shares for basically zero. All right, let's look a little closer at the fresh issue capital, the money actually entering the business. The company explicitly states 2 primary goals here. First, they plan to use about 27 crore rupees for capital expenditure, specifically to set up a brand new assembly unit down in Bengaluru. But check out the larger allocation. They plan to use over 36 crore rupees just to fund incremental working capital requirements. That heavy weighting toward working capital is a huge clue about the day-to-day operational realities of the EPCC industry, which we're going to unpack right now in our financial deep dive. Which brings us to Section 3, Forensic Financial Deep Dive. Okay, we really need to analyze this extreme divergence in their 3-year trend. If we look at revenue, it grew from roughly 104 crore rupees in FY23 to nearly 158 crore in FY24. That's solid, healthy top-line growth for sure. But wait, look at profit after tax, or PAT. It rocketed from a mere 28 lakh rupees in FY23 to a staggering 16.3 crore rupees in FY24. Guys, that is a mind-blowing 5,691% increase in profit in a single year, even though their revenue growth was, well, far more moderate. So how do we explain that massive profit explosion? We look at the EBITDA margin.
This is essentially how much operating profit a company actually keeps from every single rupee of revenue it earns. Back in FY23, Leapfrog's EBITDA margin was razor thin, just 0.96%. But by FY24, it jumped to 12.50%. And for the 9 months ended December 2023, expanded even further to nearly 20%. Now, a sudden, aggressive margin expansion in the immediate run-up to an IPO is something forensic analysts literally always flag for intense scrutiny. I mean, you really have to ask yourself, did the underlying business miraculously become 20 times more efficient practically overnight? Or is this just the peak of a very specific, lucky contract cycle?
And that brings us to the harsh reality of their cash flow. Remember how the biggest chunk of the IPO money is going straight toward working capital? Well, this explains exactly why. In the EPCC industry, booking a massive profit on your income statement absolutely doesn't mean you immediately have that cash sitting in the bank. The company itself notes that capital gets stuck as current assets. They have to buy materials up front, maintain inventory, pay their suppliers in advance, and critically, they have to wait for outstanding debtor realization, which is just a fancy way of saying they're waiting for clients to actually pay their invoices. On top of that, clients often hold back retention deposits until a project is 100% complete. So despite those exploding profits on paper, their actual cash is heavily tied up in the daily grind of fulfilling these massive contracts.
All right, let's pivot to Section 4, Key Risks and Red Flags. Now, what's really interesting here is that the company explicitly warns investors about that exact concentration we talked about earlier. They flat out state that the loss of or even a significant reduction in orders by just a few key customers could severely hurt their financial condition. Furthermore, because these are project-based contracts, there's this constant, relentless pressure to secure new government and private sector leads just to maintain their current revenue, let alone grow it. And finally, management is very clear that there's no absolute guarantee that deploying the IPO proceeds will actually result in increased value or profitability. It's a tough business.
Moving on to Section 5, Peer Comparison and Valuations.
In the RHP, Leapfrog lists Constellec Engineers Limited as a listed industry peer. But when we put them side by side, a pretty stark difference emerges. Over the same recent periods, Constellec, which is an established player in this exact same space, has maintained EBITDA margins somewhere between 6.8% and 8.4%. Leapfrog, on the other hand, is currently reporting margins between 16% and 20%. As an objective observer, this really prompts a critical question. Is Leapfrog genuinely executing projects at double the efficiency of its listed peers? Or are these incredibly high recent margins a short-term anomaly that might eventually just revert to the industry mean? Of course, we also have to talk valuation. Now, transparently, because this is just a draft RHP, the final price-to-earnings or PE ratio at the upper price band is currently blank. That'll be decided closer to the actual IPO date. But we can look at their return on net worth or RONW. In FY23, it was a very modest 5.32%. Fast forward to FY24, driven by that massive profit spike we saw, and it hit an extreme 75.51%. Whenever that final issue price is announced, you absolutely must weigh it against the fact that these historical returns are highly volatile and heavily inflated by a very recent short-term surge in profits. And that brings us to Section 6, the final takeaway. So, what's the fundamental profile of Leapfrog Engineering Services, based purely on their own disclosures? Well, on the operational side, they are a growing EPCC business with some serious technical expertise across diverse, high-value sectors like oil and gas and pharmaceuticals. However, financially speaking, their recent track record shows an aggressive, sudden margin expansion right before the IPO. Structurally, they operate with extreme customer concentration, literally relying on just a handful of clients for nearly all their revenue. And finally, the very nature of their business demands a heavy reliance on working capital, meaning a lot of their on-paper profit is temporarily trapped in trade receivables and retention deposits. Ultimately, making sense of all this comes down to weighing these hard RHP numbers against your own personal risk appetite. So I want to leave you with this final, provocative question to help empower your own due diligence. Do you believe Leapfrog's exceptionally high, sudden pre-IPO margins are sustainable enough to outweigh their extreme customer concentration and structural working capital risks? Thank you so much for joining me for this explainer. Keep digging, keep analyzing, and I'll catch you in the next one.